From 2020 to 2023, the dominant expectation among economists, investors, and the public was not just slow down, but collapse. The world economy was hit by a sequence of shocks that, taken together, looked historically unprecedented. A global pandemic shut down entire sectors overnight. Supply chains snapped, not gradually, but all at once. Governments injected trillions in emergency spending. Inflation surged to levels not seen in decades. Central banks then reversed course aggressively, raising interest rates at the fastest pace since the early 1980s. In past cycles, any one of these shocks would have been enough to trigger a deep global recession. This time, they arrived almost back to back. And yet, the collapse never came. By 2024 and into 2025, growth slowed, but the global financial system did not freeze. Unemployment rose in some regions but did not explode. Banks failed in isolated cases, but contagion was contained. Asset prices adjusted sharply, then stabilized. By 2026, institutions like the World Bank and IMF were no longer talking about crisis management, but about a weaker, slower expansion. That outcome surprised many people, especially those who expected the post-pandemic economy to unravel under the weight of inflation, debt, and tightening financial conditions. To understand why the global economy avoided collapse, it is important to separate what did happen from what did not. Inflation surged, but it did not spiral into hyperinflation. Interest rates rose, but financial markets continued to function. Growth slowed, but output did not contract across most major economies. This was not a story of economic strength. It was a story of resilience under pressure. One reason is that policymakers reacted faster and more decisively than in past crises. During the early months of the pandemic, governments and central banks acted with a speed that would have been unthinkable in earlier decades. Fiscal support was deployed at massive scale to prevent households and firms from collapsing all at once. Central banks cut rates to zero, provided emergency liquidity, and backstopped key markets. These measures did not create growth, but they prevented a complete breakdown of demand and credit. When inflation later surged, the policy response again differed from previous episodes. Central banks, particularly the U.S. Federal Reserve and the European Central Bank, moved aggressively to restore credibility. Interest rates were raised sharply, even at the risk of slowing growth. This tightening caused pain, especially in housing, technology, and emerging markets. But it also prevented inflation expectations from becoming unanchored. By 2024 to 2025, inflation in many advanced economies began to stabilize without triggering a global recession. Another critical factor was the condition of the financial system entering the crisis. After the 2008 financial meltdown, banks in advanced economies were forced to hold more capital, reduce leverage, and undergo stress testing. These reforms were often criticized during the low-rate years for limiting lending and growth, but they mattered when the shock arrived. When rates rose rapidly after 2022, banks faced losses on bonds and loans, yet most had enough capital to absorb them. There was no global banking panic comparable to 2008, when confidence evaporated overnight. Households also entered this period in a different position than before previous crises. In many countries, pandemic-era support allowed households to reduce debt and accumulate savings. While those buffers were unevenly distributed and gradually eroded by inflation, they helped sustain consumption longer than expected. Consumers cut back, but they did not disappear from the economy. That mattered more than many forecasts assumed. Corporations, especially large ones, had also locked in low-cost financing during the years of near-zero interest rates. When rates rose, the immediate impact on their debt servicing costs was muted. This delayed the wave of bankruptcies that often turns a slowdown into a collapse. Instead of sudden break, adjustment happened gradually. The structure of global trade also played a role. While supply chains were disrupted, they did not disintegrate. Firms adapted by diversifying suppliers, holding more inventory, and rerouting logistics. These changes reduced efficiency, but increased resilience. Globalization did not end, but became less optimized for cost and more for reliability. That shift slowed growth but reduced vulnerability to single points of failure. It is important to be clear about what avoiding collapse actually means. It does not mean the economy returned to the rapid growth of the 2010s. It does not mean living standards rose quickly or evenly. It simply means that the system absorbed shocks without a cascading failure. Output continued to grow, albeit slowly. Financial markets adjusted rather than imploded. Institutions remained functional. This distinction matters because many people confuse stability with health. An economy can be stable and still fragile. It can avoid collapse while losing momentum. That is exactly the position the global economy found itself in by the mid-2020s. By 2026, growth forecasts around 2.6 to 2.7% reflected this new reality. The world was no longer overheating, but it was not accelerating either. The era of emergency had ended, but the conditions for a strong rebound were missing. Productivity growth remained weak. Investment was cautious. Governments faced high debt and limited fiscal space. Monetary policy could no longer rescue growth without reigniting inflation. In other words, the absence of collapse was not a sign of success. It was a result of trade-offs. Policymakers chose stability over speed, containment over expansion. That choice worked in the narrow sense of preventing disaster, but also set the stage for a slower, more constrained global economy. Understanding why the collapse did not happen is the first step. The more important question comes next. If the system is stable but slowing, what kind of recovery is this? And who is it actually reaching? By the time the fear of outright collapse faded, a different puzzle took its place. If the global economy had survived inflation, rate shocks, and geopolitical stress, why did growth feel so weak? Why did forecasts for 2026 and 2027 cluster around numbers like 2.6 to 2.7% instead of something closer to pre-pandemic average? To many people, this felt counterintuitive. Survival should have led to acceleration. Instead, the world entered a slower gear. The key to understanding this lies in recognizing that the forces slowing growth are not cyclical in the usual sense. They are structural. In past recoveries, growth rebounded because interest rates fell, credit expanded, and globalization pushed costs down. This time, those engines are either unavailable or working in reverse. The first and most visible break is the cost of money. For more than a decade after the global financial crisis, the world lived in an abnormal environment of near zero interest rates. Capital was cheap, sometimes almost free. That environment encouraged borrowing, asset expansion, and long-term investment decisions based on the assumption that financing would always be easy. After the inflation surge of the early 2020s, that assumption broke. Even as inflation cooled, central banks made it clear that policy rates will remain higher than in the 2010s. Real interest rates moved back into positive territory. This change matters because it resets the hurdle for investment. Projects that made sense when money cost 1% no longer make sense at 4 or 5%. Companies delay expansion. Venture capital becomes more selective. Real estate development slows. None of this causes a crash, but together it drags on growth year after year. The economy keeps moving, but with more friction. Demographics add another layer of drag, especially in advanced economies. Aging populations mean slower labor force growth and rising dependency ratios. Fewer workers support more retirees. Productivity gains would need to accelerate just to maintain previous growth rates. Yet productivity growth has been disappointing for years. Technology continues to advance, but its economy-wide impact has been uneven and slower than many expected. Artificial intelligence promises gains, but translating potential into broad productivity takes time, capital, and institutional adaptation. At the same time, globalization is no longer a pure accelerator of growth. The decade before the pandemic were defined by deep integration, just-in-time supply chains, and relentless cost optimization. That model delivered lower prices and higher efficiency, but it also created fragility. When shocks hit, the system bent too far. In response, firms and governments shifted priorities. Resilience began to matter more than efficiency. This shift shows up in strategies like reshoring, nearshoring, and friendshoring. Supply chains are being diversified geographically, often at higher cost. Inventory levels are kept higher. Redundancy replaces optimization. These changes reduce the risk of sudden breakdowns, but they also raise expenses and lower measured productivity. Growth does not disappear, but becomes slower and more expensive. Public finances are another constraint. Governments emerged from the pandemic with much higher debt levels. During the crisis, borrowing was necessary to prevent economic freefall. In the aftermath, however, high debt limits flexibility. Large-scale fiscal stimulus becomes politically and financially harder to justify. Interest payments consume a larger share of budgets, especially when rates are higher. As a result, governments focus more on stabilization than on aggressive growth promotion. This is a crucial difference from past recoveries. In earlier periods, fiscal and monetary policy often worked together to push growth above trend. By the mid-2020s, that coordination weakened. Central banks remain cautious, prioritizing inflation control. Fiscal authorities face constraints. The policy mix supported stability, not speed. Another reason growth feels slow is that the benefits are unevenly distributed. Aggregate global numbers hide significant variation across regions and sectors. Some economies continue to expand at healthy rates, while others stagnate. Some industries thrive, while others struggle. When growth is broad-based, it feels stronger. When it is narrow and uneven, it feels fragile, even if the headline number remains positive. Financial conditions also play a role. Even as markets stabilized, they became more selective. Capital flows to safer assets and stronger balance sheets. Riskier borrowers face higher premiums or are shut out altogether. This reduces the likelihood of bubbles, but it also slows innovation and expansion in parts of the economy that rely on external financing. Again, the system becomes safer, but less dynamic. Importantly, this slowdown is not the result of a single mistake or shock. It is a cumulative outcome of deliberate choices. Policymakers chose to prioritize inflation control over rapid expansion. Firms chose resilience over maximum efficiency. Households chose caution after years of uncertainty. Each decision made sense in isolation. Together, they produce an economy that moves forward, but carefully. This helps explain why the term new normal returned to economic discussions. The phrase does not imply permanent stagnation, but it does imply adjusted expectations. Growth rates that once felt disappointing now represent stability. Volatility is lower, but so is momentum. Understanding this shift is essential because it reframes the question facing the global economy. The issue is no longer whether growth will collapse. It is whether slow growth can be sustained without generating new tensions. Low growth makes debt harder to manage, inequality more visible, and political patience thinner. It leaves less room for error. The world avoided collapse by accepting slower expansion. That trade-off bought time and stability. But it also set limits on how fast living standards can improve. The economy is not broken, but it is constrained. And those constraints shape everything that comes next. The slowdown, then, is not a temporary pause before a rebound. It is the background condition of the current global economy. To understand its consequences, we have to look beyond averages and ask who is actually recovering and who is being left behind. When people talk about a global recovery, they often imagine a shared upward movement, as if countries rise together on the same tide. In reality, the post-pandemic recovery has been anything but uniform. By the mid-2020s, the world economy was no longer divided simply between growth and recession, but between economies that had already moved beyond their pre-2019 income levels and those still struggling to regain lost ground. This unevenness is one of the clearest signs that the current expansion is fragile beneath the surface. In many advanced economies, average income levels surpass their 2019 benchmarks by 2024 or 2025. The United States, parts of Western Europe, and several high-income Asian economies managed to recover output relatively quickly. Strong fiscal support during the pandemic, Deep financial markets and access to cheap capital in earlier years allowed these countries to absorb shocks more effectively. Even when inflation surged and interest rates rose, the institutional capacity to respond remained intact. Growth slowed, but the recovery line never fully broke. For households in these economies, the recovery felt incomplete but real. Employment rebounded faster than expected. Wage growth, while uneven, eventually caught up with inflation in some sectors. Asset prices corrected but did not collapse permanently. By the time growth forecasts settled into the mid 2% range globally, many advanced economies were already operating above their pre-pandemic income levels, even if optimism remained muted. The picture looks very different across large parts of the developing world. According to international estimates, roughly one quarter of developing economies entered 2026 with per capita income still below where they stood in 2019. For these countries, the pandemic was not just a temporary disruption, but a lasting setback. Lost income was not fully recovered. Investment gaps widened. Fiscal space narrowed. What appeared as a slowdown in richer economies often felt like stagnation or reversal elsewhere. One reason for this divergence lies in access to finance. Advanced economies borrow in their own currencies and enjoy deep, liquid capital markets. When crisis hits, they can issue debt at scale. Developing economies often cannot. Many rely on external borrowing, frequently denominated in foreign currencies. When global interest rates rise, debt servicing costs increase sharply. When capital flows reverse, currencies weaken. Even prudent fiscal policy can be overwhelmed by external conditions. The post-2022 tightening cycle exposed these vulnerabilities. As rates rose in the United States and Europe, capital flowed back towards safer assets. Developing economies face higher borrowing costs at the exact moment they needed investment the most. Some were forced to cut spending. Others accumulated debt under worsening terms. Growth slowed not because of domestic collapse, but because the external environment turned hostile. Inflation also played out differently. In advanced economies, central banks eventually managed to bring inflation down without triggering mass unemployment. In many developing countries, inflation hit harder and lasted longer. Food and energy prices carry more weight in household budgets. Currency depreciation amplified price pressures. Efforts to control inflation through tighter policy often came at the cost of growth, creating painful trade-offs. Structural factors deepen the gap. Economies with diversified industrial bases and strong service sectors adapted more easily to post-pandemic conditions. Those dependent on a narrow range of exports, tourism, or remittances faced slow recoveries. Supply chain realignments benefited some countries but bypassed others. The promise of friend-shoring did not automatically translate into broad inclusion. Investment flowed selectively, not evenly. Even within countries, the recovery followed different paths. Urban, high-skilled workers often rebounded faster than rural or informal workers. Large firms recovered more quickly than small ones. Digital sectors expanded while traditional industries lagged. These internal disparities reinforce the sense that recovery is partial, not comprehensive. This unevenness matters because global growth is an aggregate of very different national realities. When advanced economies grow modestly and large parts of the developing world struggle, the global number may look stable while underlying tensions build. Weak growth in poorer countries makes debt harder to manage and social pressures more intense. It also limits their ability to invest in health, education, and infrastructure, which are essential for long-term convergence. There's also a feedback loop. Slow recovery in developing economies reduces global demand. That, in turn, weighs on export growth elsewhere. The world economy becomes more fragmented, with fewer shared engines of expansion. Stability is preserved, but momentum fades. Crucially, this divergence challenges the idea that the current phase represents a normal recovery cycle. In past global rebounds, emerging and developing economies often grew faster than advanced ones, narrowing income gaps. This time, that pattern weakened. Some countries still achieved strong growth, but many did not. The result is a world that is technically expanding, yet increasingly divided. This division reinforces a theme of growth, yet fragile. The system holds together, but its foundations are uneven. Advanced economies can tolerate slower growth because they start from higher income levels. Developing economies cannot. For them, slow growth risks becoming lost time. By the mid-2020s, it became clear that the global economy was not healing symmetrically. It was adjusting asymmetrically. Some countries moved ahead cautiously. Others remained stuck, constrained by debt, weak currencies, and limited policy space. The headline numbers concealed this reality, but the consequences were visible in politics, migration pressures, and rising dissatisfaction. Understanding who has recovered and who has not is essential, because fragility does not come only from shocks. It also comes from imbalance. A world where growth is uneven can remain stable for a while, but it carries latent risks. Those risks do not always announce themselves through immediate crises. Sometimes they build quietly, until a small disturbance exposes how little margin for error actually exists. By the mid-2020s, the global economy had settled into a strange equilibrium. Inflation was no longer spiraling. Financial markets were calmer. Growth, while slower than in the past, remained positive. On the surface, this looked like a successful normalization after years of crisis. But beneath that surface, the system remained unusually sensitive to disruption. This is what makes the current phase best described not as recovery or stagnation, but as growth yet fragile. Avoiding collapse did not eliminate risk. It redistributed it. Instead of a single overwhelming crisis, the world now faces a collection of smaller, persistent vulnerabilities. None of them, on their own, guarantee disaster. Together, they leave little room for error. The global economy is moving forward, but without the buffers that once made growth resilient. One of the most important sources of fragility is the narrow policy margin. After years of extraordinary measures, both monetary and fiscal authorities have less flexibility than before. Central banks remain cautious, aware that loosening too quickly could reignite inflation. At the same time, keeping rates high for too long risks choking investment and destabilizing weaker borrowers. This balancing act leaves little tolerance for miscalculation. Policy mistakes that might once have been absorbed could now have outsized effects. Fiscal policy faces similar constraints. High public debt limits the ability of governments to respond forcefully to new shocks. In many countries, interest payments already consume a growing share of public budgets. This reduces spending on infrastructure, social programs, and long-term investment. If another downer arrives, the response is likely to be more selective and slower than during the pandemic. Stability is preserved, but at the cost of resilience. Geopolitical risk adds another layer of uncertainty. Trade tensions, regional conflicts, and strategic competition have become semi-permanent features of the global landscape. Even when these tensions do not escalate into full-scale crises, they influence economic behavior. Firms delay investment. Supply chains remain cautious. Energy and commodity markets stay vulnerable to sudden disruptions. Growth continues, but confidence remains fragile. Debt is another fault line. While a global debt crisis has not materialized, pockets of stress remain. Several low and middle-income countries face debt burdens that are manageable only under favorable conditions. Slower growth and higher rates make these conditions harder to maintain. A localized default may not trigger a global collapse, but it can spread uncertainty, tighten financial conditions, and reinforce risk aversion. Fragility does not require a system-wide breakdown. It only requires enough weak points to amplify shocks. Financial markets themselves reflect this tension. Volatility has declined compared to peak crisis periods, but risk appetite remains selective. Investors favor strong balance sheets and stable cash flows. Speculative excesses are fewer, yet so are bold expansions. This reduces the likelihood of bubbles, but it also dampens dynamism. The system is safer, but more cautious, and caution limits growth. Climate-related risks further complicate the picture. Extreme weather events disrupt production, raise insurance costs, and strain public finances. The transition to lower carbon energy systems requires massive investment at a time when capital is more expensive and public budgets are tight. These pressures do not cause immediate collapse, but they add to the background fragility, increasing the likelihood that small shocks compound into larger problems. What makes this moment distinctive is that fragility coexists with stability. The economy is not overheating. Financial institutions are not collapsing. Employment in many places remains relatively strong. And yet, there is no strong engine pulling the system forward. Growth depends on careful balance rather than momentum. When momentum is absent, the cost of disruption rises. This helps explain why confidence remains subdued even in the absence of crisis. Businesses plan defensively. Households remain cautious. Governments avoid bold experiments. Everyone remembers how quickly conditions changed earlier in the decade. That collective memory shapes behavior, reinforcing the slow, careful pace of expansion. The central message of this period is not that collapse is imminent. It is that stability has been purchased at the price of speed and flexibility. The global economy is like a structure that has been reinforced to withstand shocks, but not redesigned for rapid growth. It can endure pressure, but it cannot easily accelerate. This distinction matters for how the future is understood. If growth remains slow but positive, tensions will accumulate quietly. Debt will feel heavier. Inequality will become more visible. Political patience will thin. None of these outcomes require a dramatic crisis to matter. They unfold gradually, testing the system over time. The world has entered an era where avoiding collapse is no longer the main challenge. The challenge is sustaining progress in an environment where every gain is harder to achieve and every mistake carries greater consequences. Growth continues, but it does so on a narrow path. That is the paradox of the global economy in the mid-2020s. It is stable enough to endure, yet fragile enough to falter. The absence of disaster should not be mistaken for strength. It is simply the result of a system that has learned how to survive under strain, even as it struggles to move forward with confidence.